Okay. Good evening to you all. We are going to start the part 2 of the session 8. If I recall what we have covered so far during the previous session 8 part 1, there we introduced the exchange rate and the central banking. Basically, we discuss what are the key theories that we can see in the economy, which gives you the foundation to understand the determination of the exchange rate, right? If you can recall the memory of the previous session, basically we discussed four main theories which helps us to understand the determination of the exchange rate. So what are these four theories that we discussed? The first one, we discussed the purchasing power parity theory, right? There we discuss how the relative purchasing power parity and absolute purchasing power parity helps us to determine the exchange rate. And next we discuss about the uncovered interest parity. Under that theory, we discuss the interest rate differential and the expected depreciation of the exchange rate determine the equilibrium exchange rate. And thirdly, we discuss the portfolio balance model. So here the portfolio balance model loosen up some of the uh, unrealistic assumptions made and the uncovered interest parity theory, and it gives you the room to make that the some of the foreign assets and the uh, domestic assets are not perfectly substitutable. Likewise, always these investors are diversifying their risks, thereby they hold both foreign and the domestic assets. Likewise, the theory suggests how the exchange rate might determine under that portfolio model theory. And lastly, we discuss about the exchange rate market microstructure. So these basic main three theories always focus about the macro sector, but under the fourth theory, we discuss how the microstructure or the micro sector, these individuals, firms, financial institutions, how they involve in the process of the determination of the exchange rate. So that's what we discussed during the part 1 of the session 8. There finally we came to the conclusion that there is no uniform theory that we can apply for the exchange rate determination. So from economy to economy, based on the practical aspect and the inherent economic features, we cannot apply fully some of the theories to our country or to another country. So country to country, the application may be changed, but overall what these theories do, they provide the foundation to understand the determination of the exchange rate. Okay, and also we discussed that in if we compare the theories with the practical scenario, maybe there are contradiction between the theory and the practice. Even though the theory suggests that this should be happen according to the theory, in practice maybe the practical scenario can be changed. For an example, theory suggests that if the exchange rate depreciate, the country's export should be accelerated. But in practice, if we take Sri Lankan context, we can see that our exchange rate also sharply depreciated. But if we compare that sharp depreciation with the export acceleration, we did not obtain such massive export acceleration. So in practically, the context of applicability of these theories can be changed. So it's duty of us to rationalize the theory and rationally argue to what extent these theories can be applied in the practical aspect. So having said that, today we are going to discuss how the central bank influence the exchange rate. So in which ways the central bank can influence the exchange rate. Okay, so that is the lecture outline for today's session. When we are discussing this, We can talk about under two approaches or two sectors. We can discuss how the central bank influence the exchange rates under the macro concept, and also we will be discussing the influence of the central bank to the exchange rate under the operational level. Okay, so here the first part we are going to discuss about the macroeconomy, how the central bank influence the exchange rate and how might it affect the macro concepts or the macroeconomy. Okay, so here when we are discussing about the macroeconomy, we know there are some main macroeconomic variables like interest rate, inflation rate, exchange rate, GDP growth, likewise. So always these macroeconomic variables are interconnected. So throughout our previous sessions also we discuss about these interlinkages between these macroeconomic variables. So basically here, under this macro approach to the central bank influence on the exchange rate, we discuss how might the influence on the exchange rate by the central bank can result an impact on the other macroeconomic variables in the economy. For an example, we say any policy action to affect one of these three variables will affect not only the variable in question, but will also indirectly affect the other two. What that says, what is the meaning of that statement? That means even though the central bank want to influence the exchange rate for an instance, but doing that, there might be an indirect impact on the other macroeconomic variables in the economy. So always when the central bank is dealing with the exchange rate or influencing the exchange rate, they have to take, they have to keep on mind that there can be other indirect results on the other macroeconomic variables. For this stage, we are going to discuss the three macroeconomic variables: interest rate, inflation rate, and exchange rate. How the interlinkages between these three variables might result in direct effect on the macroeconomy. So for an example here, we are going to discuss how the central bank policy action might affect one variable and also affect the other two variables through indirect impact. Okay. So let's say for an example, central bank want to keep the domestic interest rate lower, right? So the central bank want to keep the domestic interest rate lower. Maybe that they want to, by keeping the interest rate lower, they want to accelerate the economy a bit, or they might follow a loosened monetary policy to accelerate the economy. So they might decrease the domestic interest rate. So now the policy decision of the central bank is mainly influence the interest rate. So they are lowering the policy interest rate or the domestic interest rate. But when they reduce the domestic interest rate, if you can remember our one theory, uncovered interest parity, there they suggest the domestic interest rate and the foreign interest rate. If there is a difference between these two interest rates, and that differential will be compared with the expected depreciation of the foreign exchange. But if there is a change between these two, there might be some arbitration activities, right? Capital inflows or outflows. That's what we discuss under the uncovered interest parity theory. Here, this uncovered interest parity theory suggests that to have an equilibrium exchange rate, always the interest rate differential should be equal to the expected depreciation of the exchange rate. So please recall the equation that we refer in the previous slide set. We used precise equation to discuss the uncovered interest parity. So according to that, if there is a change between foreign interest rate and the domestic interest rate, as the theory suggested, there might be a resulted of capital inflow or an outflow. So for this example, they say central bank keeps lower domestic interest rate. So suppose that now you are the investor. Now there is a domestically lower interest rate, but if you compare that domestic lower interest rate with a foreign interest rate, you can see the foreign interest rate is higher, right? So being a rational investor, now what you should do, you might invest in foreign market, right? Not in the domestic market, because the domestic interest rate gives you a lower return because of the lower domestic interest rate. So accordingly, when there is a lower domestic interest rate, it will result a capital outflow. When there is a capital outflow, what will happen to the exchange rate? We know the foreign exchange demand and the supply will determine the exchange rate in the economy. So when there is a capital outflow means we are investing in the foreign sector. For that we are demanding the foreign exchange and we are not demanding the domestic currency. We are demanding foreign currency. So when the demand for the foreign currency increases, that means on the other hand demand for the domestic currency decrease. So it will result in depreciation pressure on the exchange rate. So you see the central bank influence only the interest rate by keeping it low, but ultimately it created an adverse impact on the exchange rate because now our exchange rate is depreciated. So that's the relationship between the exchange rate and the interest rate. Similarly, let's suppose that there is a higher inflation rate in the economy. So if you can recall the memory for the purchasing power parity theory, especially the relative PPP, under the relative PPP, they suggest that if there is an inflation in one economy, accordingly the exchange rate also should be depreciated. Why? When there is inflation, purchasing power parity also, the purchasing power of the currency also decrease. Accordingly, when there is inflationary pressure, our exchange rate should be depreciated. So now you can see inflation leads to depreciation of the exchange rate. Similarly, let's suppose that now we are having a lower domestic interest rate. That means our interest rate is lower. So to keep the lower interest rate, what we do, normally we increase the money supply. Please recall the memory on the macroeconomy ISLM analysis, the interest rate and the money supply, right? When we are changing the money supply, we can keep the interest rate low. So by increasing the money supply, we are keeping the interest rate low. So when we are increasing the money supply to keep the interest rate low, higher money supply ultimately will lead to higher inflation, right? So now you can see all these three variables, interest rate, exchange rate and inflation rate are interrelated. We say they are intertwined. So when one variable changes, there might be an impact on the other variable or the other two variables. So we cannot directly influence one variable without affecting the other two variables. So that's why under the macro level, central bank always have to keep that on their mind before before influencing one variable. There is a indirect impact on the other variables. So we are going to discuss this by using a practical scenario. Here now we have used this statement. Let's suppose there is an instance. There is a 100,000 worth of goods. So suppose that now we have 100,000 worth of goods. So where the central bank wants to hike interest rate to keep inflation down. That means they want to increase the interest rate to keep the inflation down. So how that can happen? When higher the interest rate, lower the price, how that can happen? When there is a higher interest rate, that means basically the borrowings will be discouraged, right? The borrowing cost is now higher, so the demand will go down. So when the demand will go down, the prices will also go down, right? When there is a lower demand, the prices also low. So that's how the higher interest rate might result the lower inflation. So now the central bank wants to do that. They want to increase the interest rate to keep the inflation down. But at the same time, they want to keep exchange rate weak in order to stimulate exports. That means they want to increase the interest rate because they want to keep the inflation down. Simultaneously, they want to keep the exchange rate weak mean fixed. They want to keep the exchange rate fixed in order to stimulate the exports, because if our exchange rate appreciate, it will make our exports less competitive. So they want to keep the exchange rate fixed. So what might be the consequences of such a decision? Now we are asking you. Central Now there are some of specification that central bank wants to do in the economy. They want to increase the interest rate to keep the inflation down. Similarly, they want to keep the exchange rate fixed in order to stimulate exports. So if that's the scenario in the economy, what might be the consequences of such a decision? Let's elaborate this scenario using our knowledge on the macroeconomics. Alright. Let's say now central bank want to uh, keep the interest rate high in order to in order to reduce the price level. That means if we take like this is the interest rate, right? So we know this is the money demand. We know the money supply is constant, M over P. So now this is the determined interest rate here. Now the central bank wants to make it higher. So to make it higher, we know we want to reduce the money supply. So then the interest rate will go up. Now the interest rate here, it goes up from I1 to I2 by reducing the money supply. So when they reduce the money supply by keeping the interest rate higher, ultimately it will result a lower inflationary pressure in the economy. That's what they want to do. But when they are doing that, simultaneously, they want to keep the exchange rate also fixed in order to stimulate their export. Let's suppose now this is the let's suppose this is the determined foreign exchange. This is the foreign exchange demand. This is the foreign exchange supply. So here we have the equilibrium. Here we have the equilibrium foreign exchange rate. So now central bank made this decision to increase the interest rate. Now they increase the interest rate. When they increase the interest rate, what happened? Now they increase the interest rate means now the domestic interest rate is higher than the foreign interest rate, right? Because now our interest rate here increased. Now what happened? Our domestic interest rate is higher than the foreign interest rate. So as the uncovered interest parity theory suggested, if this is the scenario, we should be expecting a capital inflow, right? When there is a higher interest rate in the domestic economy, our there should be a capital inflow. Other investors from the other countries will invest here, because now by investing here in Sri Lanka, they can earn a higher return compared to the foreign interest rate. Now we are having a higher interest rate in the domestically. So we are expecting a capital inflow. Normally, when there is a capital inflow, that means our foreign exchange supply will go up, right? So our foreign exchange supply will here go up. Accordingly, it will result appreciation in the foreign exchange, right? That means here the exchange rate is going down, means previously for a $1 we have to pay 180 rupees. Now because of the capital inflow, for a $1 we have to pay only, let's suppose, 160 rupees. That means the domestic currency uh, appreciated, right? Now we have a stronger domestic currency, so our foreign exchange appreciated, the exchange rate is appreciated. But as we discussed here, the central bank can't do that, because together with the higher interest rate, they want to keep the exchange rate also fixed. That means they want to keep the exchange rate here at this level, not here. For that, they want to take back the foreign exchange rate here to the previous level. For that, they have to do something. They have to engage in foreign exchange intervention, right? Maybe selling foreign currency or buying foreign currency. So that means here they cannot let this to happen. They want to interfere in the foreign exchange market and keep the exchange rate here at the fixed level, because this is the fixed level in the economy, fixed exchange rate in the economy. If that's the case, if that's the case, then what have the central bank has to do? What type of strategies that the central bank has to do? Now you have a basic background idea what is the situation in the economy. Central bank increase the interest rate. When the central bank increase the interest rate, as the uncovered interest parity suggested, there should be a capital inflow. So when there is a capital inflow, our exchange rate should be appreciated. But since the central banks want to keep the exchange rate fixed in order to stimulate the export, we cannot allow this exchange rate appreciation. Then the central bank has to interfere in the foreign exchange market, right? They might have to inject money in order to satisfy the greater demand for the domestic currency. So the injection of the money will of course defeat the initial purpose of the hike in the interest rate, right? What is the initial purpose? They want to keep the inflation down, but simultaneously they want to maintain the fixed exchange rate. So what they do, they inject money in order to keep the exchange rate at the determined level. When they inject money into the system, ultimately it will keep an inflationary pressure. So their primary objective of keeping inflation down is now hampered, right? So there is a compromise between the two goals, fixed exchange rate and the low inflation level. Now you see, always when central bank go ahead with one policy decision, they have to keep on mind what might be the impact on the other policy macroeconomic variables or the other policy decisions, right? So now you have an idea, higher interest rate or the lower inflation and fixed exchange rate, that is a scenario where we cannot practically achieve that, right? So later ultimately the result, it will result the hampering of inflation in the economy. All right. So this scenario, this instance or this example gives you the idea how this interrelation or interlinkage between the macroeconomic variables results contradictory effects on the macroeconomy. All right. So here, if we want to keep the exchange rate fixed, ultimately it we have to violate the uncovered interest parity. Why? As uncovered interest parity suggested, when there is an interest rate differential, there should be a expected depreciation in the currency, right? I'm again referring to that precise equation we learned under the uncovered interest parity. So when the domestic interest rate is higher than the foreign interest rate, there is a capital inflow. So to get the equilibrium exchange rate under the UIP, uncovered interest parity, there should be a expected depreciation of the exchange rate. But since we are having a fixed exchange rate here, that means expected depreciation is zero. In other words, we are violating the UIP or the uncovered interest parity. So here, but as a conclusion or as an overall conclusion here, what you have to note down, we cannot only affect one variable, always central bank to consider the other indirect effects on the other variables as well, right? For an example, if this is the case, at the end, central bank have to uh, make the inflation accelerated because of the fixed exchange rate target, right? So ultimately, the central bank cannot have both low inflation and fixed exchange rate objectives. So if this is the case, if the public know that central banks want to keep the inflation low as all as same as a fixed exchange rate simultaneously, then the public might be skeptical about the effect that the hike in the policy interest rate might have on inflation. So at the end, central bank itself might lose their credibility because at the end they fail to keep inflation down. So if they announce lower inflation and also fixed exchange rate, then the public might know, okay, the central bank might fail at the end. They cannot keep those two objectives together. So the credibility of the monetary policy might be lost, right? So that's what this interlinkage between the variables do in the economy, right? So for an example, similarly, let's suppose that this large scale foreign exchange intervention without sterilization. Here we discussed what is meant by sterilization in our previous session. At the latter part of the this session also we will again discuss the sterilization process as well. So without a sterilization, if the central bank keep on intervening on the foreign exchange market, ultimately their price stability objective might be hampered. So that's what we have to know at this stage. There is interlinkages between the variables. Because of that, always central bank has to compare and contrast their policy decision on the macroeconomic variables, inflation, exchange rate, and the interest rate. So that's what we have to know under the macro level. So having said that, accordingly, central bank have to determine what type of exchange rate that they are going to maintain. It can be a fixed exchange rate, or it can be a freely float exchange rate. That means the exchange rate they might allow to determine 100% according to the market forces. If that happens, that is the freely float exchange rate. But if the central bank wants to keep the exchange rate at the predetermined level, that is the fixed exchange rate. Or in practice, central bank might keep the exchange rate at a managed floating system. That means not a fixed, not a freely float, in between some level. So they might allow the exchange rate to vary between the given target. So that is the managed floating rate. So that's how the central bank determine the exchange rate under the macro level. Comparing the results on the macroeconomic variable, they might determine what type of exchange rate that they are going to maintain in the economy. Before doing that, always they have to compare the other variables effect also. So after discussing this macro concept, now you might have this confusion. So what should be the equilibrium exchange rate in the economy, right? So what is the precise exchange rate should be in the economy? So deciding this precise rate of the exchange is a very difficult task, because from economy to economy, from macroeconomic condition to condition, this equilibrium exchange rate can be changed. So this is the exact level of the equilibrium exchange rate. Saying that this is the exact level, it is a difficult task to say that this is the exact level of the exchange rate. So there are some of equilibrium exchange rates that gives you the direction what might be the equilibrium exchange rate in the economy, right? So basically we have 5 such equilibrium exchange rates. Exchange rate that balance the current account, fundamental equilibrium exchange rate that is consistent with PPP, exchange rate that equates export prices with those of trading partners, and finally the exchange rate that equates domestic cost to foreign cost. So these are some 5 guiding exchange rates to give you an idea what type of equilibrium exchange rate should be there in the economy. So there can be many definitions. Among all the definitions, these are 5 main definitions on the equilibrium exchange rate. So a level of exchange rate that seems to suggest equilibrium in one sense does not necessarily suggest equilibrium in another, as the theory also suggested. One theory might not be fully applicable to another economy, right? Similarly, here these concepts or the definitions also might be not fully applicable into our economy or to another country's economy, but they might give you the foundation that what type of equilibrium exchange rate should be there in the economy. So starting with the first type, that is the exchange rate that balances the current account. So we say a sustained balanced current account should imply that the economy has achieved equilibrium with respect to external trade. So an exchange rate that balances the current account could thus be deemed an equilibrium exchange rate. That means if we consider the current account, if there is no deficit or surplus in the current account, that level we take what is the exchange rate. That means if our current account is at the equilibrium, we take that exchange rate as the equilibrium exchange rate under this definition. But for this definition also, there are some of drawbacks or limitation. Such limitation is the feedback loop or the time lag. So for an example, we compare the current account balance. So now the current account is in the equilibrium. Accordingly, we say, okay, this is the equilibrium exchange rate. But this balanced current account might not represent the equilibrium exchange rate due to the feedback loop between the exchange rate and the current account, because it is often uncertain and is subject to time lags. So this balanced current account that we see today does not necessarily correspond to the exchange rate that we see today, right? So that means even though we see a balanced current account today, we cannot guarantee that this balanced current account resulted because of the today exchange rate. Maybe 2 or 3 months previous exchange rate caused the current account balance today. So this time lag between the current account and the exchange rate determination might have a impact on this definition. We say feedback loop because of the time lag. And secondly, another limitation of this definition is countries are in different stages of development and investment opportunities. For an example, there can be a country that needs foreign investment. So they want foreign investment, then they might be better off having a current account deficit, right? So if they have a current account deficit, they can finance the deficit by capital inflows. So if that country need capital inflows, they might have a current account deficit. Similarly, if a country does not have local productive investment opportunities, they might better off having a current account surplus. Why? Because they can use that surplus to invest in other countries. So depending on the stages of the development and the investment opportunities, again, this definition might have limitation. Always the current account might not be in the balance or the equilibrium. Some of the countries prefer to have deficit, some countries prefer to have surplus, depending on their stage of development and the availability of the investment opportunities domestically. So these two limitations made some of the application of this definition into the practice might be problematic. So now we come to the second definition, that is the fundamental equilibrium exchange rate. So this is a variation of the first definition. So as we say that the current account should be at balance or should be in equilibrium, here we say the fundamental equilibrium exchange rate, we say that is the level that produce the optimal current account plus the normal capital flows, right? So, but here again, the feedback loop is there, uncertainty and the time lags, and also the optimal level for the country's current account and the capital flows determining this optimal level might be problematic. For one country, optimal level may be vary compared to another country. So, defining the optimal level of the country's current account, again, problematic. So, if we come to the third definition, that is the exchange rate that is consistent with PPP. This definition stresses the purchasing power parity theory. So, exchange rate that equates overall domestic price levels with international price levels, or the exchange rate that reflects purchasing power parity, we say that is the equilibrium exchange rate. So this definition consider the purchasing power parity. So this is quite popular for comparing the standards of living among the nations or among the countries. But this definition also have its drawback, because there can be some of goods which are not tradable across borders, right? Similarly, if when we are discussing the purchasing power parity also, we say purchasing power parity suggests that this exchange rate should reflect the value of the domestic currency in its ability to purchase the identical basket of goods and services across borders, right? In other words, the basket of goods and services in two countries should be having the same purchasing power parity or the same prices after adjusting to the exchange rate. So that's what the purchasing power parity theory suggested. So going ahead with this theory, we say if the purchasing power parity holds true, that is the exchange rate we should take as the equilibrium exchange rate. So the limitation of this exchange rate is there can be some goods and services which cannot be traded across borders, and also as the PPP suggested, these arbitrage activities might not be practical across the borders, right? Purchasing power parity theory suggests if there is a difference between the exchange rate and the purchasing power parity exchange rate, these arbitrage activities might make the equilibrium, might make the purchasing power parity exchange rate and the market exchange rate equal. But in reality, this such arbitrage activities might not practical. So these limitations are there with this definition as well. So if we come to the fourth definition, which is the exchange rate that equates the export prices with those of trading partners. Now here we say if there is exchange rate which equate the export prices with those of trading partners, we say that is the equilibrium exchange rate, right? So this theoretically then this rate should ensure a level playing field among countries in the global market. But in practice, this same export prices do not necessarily translate into the same profit margins in different countries. Because of the problem in the profit margins, again applicability of this definition also be problematic in the practical scenario because of the profit margins. Finally, the definition exchange rate that equates domestic costs to foreign costs. So because of the problem in the profit margin, to overcome that limitation, we go to this fifth definition. There we compare the domestic cost with the foreign cost. If these two costs are equate at a particular exchange rate, we say that is the equilibrium exchange rate. But again, even though the profit margin problem is overcome by this definition, there is another limitation in this definition as well, because if we compare the cost, even though we say this identical product should be cost same in the two locations, in practice that cannot be achieved because there are different labor market structures. So across countries, this could become complicated to measure the wage cost because of the labor market structures, right? So we say even though the products are identical, the cost might not be identical. So having said that, if I make the flow again of this session, yes, the previous session we discussed the theories. What are the theories that we can use to understand the determination of the exchange rate? Today we are going to discuss how the central bank influence the exchange rate. So the central bank can influence the exchange rate at two levels, macro level and the operation level. So the macro level always, because of the interlinkage between the variable, central bank has to make sure if they influence one variable, there can be indirect effects on the other variable. So central bank has to make sure that these other effects also be considered under their policy implementation. So then we discuss central bank can implement a fixed exchange or a freely float exchange or a managed float exchange. So accordingly, one can ask what should be the equilibrium exchange rate in the economy. So to decide a precise exchange rate that this is the equilibrium exchange rate is difficult because economy to economy, depending on the context, that can be changed. So to get a guiding instructions or to guideline, we discuss these five main definitions. So these definitions gives you the foundation to determine equilibrium exchange rate across the nations. So this definition itself have the limitation. Depending on the these limitation, we have to determine what are in our context what should be the practically applicable definition to us. Maybe for us, applicable definition might not be applicable to another country depending on their context. That's what we have to understand so far. Now the macro level we confirmed, we completed the macro level. Now we are going to start the operational level. So under the operational level, how the central bank deal with the exchange rate. So basically there are three ways that the central bank deal with the exchange rate under the operational level. So they use indirect or direct monetary policy, and secondly they intervene in the foreign exchange market. Thirdly, they use regulation regarding the capital flows. So one by one we are going to discuss these three approaches under the operational level. The first one, direct and the indirect effects of monetary policy. So the direct means the central bank can use the monetary policy to influence the exchange rate under the operational level. So the direct impact might be happen through the expectations of the participants in the foreign exchange market. Maybe the central bank announcements and the policy decision might affect the expectations of the microstructure of the exchange market, that means the individuals or the participants of the foreign exchange markets. Thereby, they might cause a direct impact on the exchange rate. On the other hand, indirect impact can be caused on the exchange rate through the macroeconomic variables, right? So when they change the policy decisions, it will result an impact on the macroeconomic variables. Thereby they will keep an indirect, they will make an indirect impact on the exchange rate using the macroeconomic variable approach. Anyway, this direct and indirect effects can be caused upon the exchange rate using the monetary policy. So if we discuss with an example, in the long run. So the monetary policy can influence the exchange rate in the long run as the purchasing power parity and the portfolio balance model predicts, right? So this indirect approach, this direct approach, the long run approach might be work relatively slowly because it takes time to time for the monetary policy to first influence the macroeconomic variables, later the exchange rate. So I'm talking about this indirect approach, right? So the indirect approach, what they do, this might happen in the long run. First, the central bank affect the macroeconomic variables, thereby later they affect the exchange rate. But this direct impact might happen in the short run. In the short run, this monetary policy announcements can influence the expectations of the foreign exchange market players. Then the exchange rate right away change as the UIP and the market microstructure predicts, right? So overall, what you have to know, there are three ways that the central bank can influence the exchange rate at the operational level. The first one is using the monetary policy. So using the monetary policy, they can directly impact the exchange rate and also indirectly impact the exchange rate. If we talk about the indirect impact, first they affect the macroeconomic variables, thereby the exchange rate. And the direct impact, that is the short run impact, they use the monetary policy announcements to affect the expectation of the foreign exchange market microstructure or the participants of the foreign exchange market, thereby changing the foreign exchange. So that is the first way that they use to affect the exchange rate under the operational level. The second way that they use is the foreign exchange intervention. So that means the foreign exchange market intervention means the act of buying and selling foreign currencies in the foreign exchange market. So the central bank directly intervene into the foreign exchange market by selling or buying the foreign currencies, right? So this is a direct intervention. So let's suppose that central bank want to buy the foreign currencies. So the central bank purchase the foreign currencies. When they purchase the foreign currencies from you, so you are the general public, I am the central bank. Now I am purchasing the foreign currencies from you. To purchase, I am paying you the domestic currency. So when the central bank purchase the foreign currency, ultimately it will increase the domestic currency supply, right? So when the domestic currency increase, there might be a downward pressure on the price of the domestic currency. In other words, there might be a depreciation in the foreign exchange rate. Why? When there is a higher money domestic currency supply, or the supply of the domestic currency is higher in the economy, that means the value of the currency going down. That means our currency is depreciating, right? So similarly, if the central bank selling the foreign currencies the other way, if I am selling you the foreign currencies, that means you are giving me the domestic currencies. So the demand for the domestic currency will go down, right? That means the I am selling you the foreign currencies, you are giving me the domestic currency. So the supply of the domestic currency will go down. Ultimately, it will create an upward pressure on the exchange rate, that the domestic currency or the exchange rate will appreciate it. So this intervention might be large enough to uh, change the exchange rate in the market. So the using foreign exchange intervention, central bank can directly influence the exchange rate by selling or buying foreign currencies in the market. So under this foreign exchange intervention, there is a concept that we have to know, that is the sterilized foreign exchange market intervention. The sterilization, what is that? I will explain the concept with an example. Let's suppose that central bank wants to increase the interest rate, or sorry, let's suppose for an example, central bank wants to impose a downward pressure on the interest rate, right? So if they want to make a downward pressure on the interest rate, that means they want to increase the money supply, right? When they are increasing the money supply, interest rate will go down. So increase in money supply means, on the other hand, they are purchasing the foreign currency. When I am purchasing the foreign currency from you, I will give back you the domestic currency. So that will result an increase in the domestic currency. It will lead to a reduction in the interest rate, right? So unless the central bank wants to also lower interest rate in the money market, then the central bank would need to sterilize the foreign currency purchase to eliminate the potential unwanted side effects on the money market interest rate. I will explain again this sterilization process with this example. Let's suppose that the foreign exchange intervention, under the foreign exchange intervention, central bank is effectively changing the supply of domestic currency. So when there is a change in the supply of domestic currency resulting from a foreign exchange intervention, there can be a potential of introducing unwanted side effects, right? Because of the foreign exchange intervention, there can be a unwanted side effect from the foreign exchange intervention, right? Because the central using the foreign exchange intervention, central bank directly affect the money condition in the economy. For an example, if they increase the supply of the domestic currency, it will pressure it will make a downward pressure on the interest rate, right? I'm explaining again with an example. Let's suppose central bank want to intervene in the foreign exchange market. For that, they are going to sell the foreign exchange. Selling the foreign exchange means I am selling you foreign exchange. For that, you are giving me the domestic currency. So the domestic currency of the economy will go down, right? There will be a deficit in the domestic currency in the economy. When the domestic currencies go down, it will create an upward pressure on the interest rate, right? But that upward pressure of the interest rate is a result that the central bank did not anticipate it, or that result was an unwanted effect from this central bank foreign exchange intervention. So initially central bank want to just intervene in the foreign exchange market by selling or buying the foreign currency, but it results a direct change in the domestic currency supply of the economy. When the domestic currency supply of the economy changes, it will result interest rate upward or downward pressure that is not wanted by the central bank. So that is an unwanted effect by the foreign exchange intervention. If the central bank wants to neutralize this unwanted effect on the interest rate, again central bank want to absorb or to inject this excess or shortage domestic currency into the economy, right? Let's go ahead with an example. Now let's suppose central bank uh, say the central bank purchase the foreign currency. Central bank purchase the foreign currency. I will again share the whiteboard to elaborate more. Okay. Now want central bank want to purchase the central bank want to purchase the foreign exchange. Now they want to purchase the foreign exchange. For that, they are doing this foreign exchange intervention, right? They do foreign exchange intervention. So when they purchase the foreign currency, or they purchase the foreign currency means, in other words, they are giving you the domestic currency, right? So the foreign exchange purchase it leads to domestic currency will go up. When there is a higher domestic currency in the economy, that means our interest rate will go down. So there is a downward pressure in the interest rate. So that is the ultimate result happen when because of this foreign exchange intervention. So if I draw the impact also, this is the money demand, this is the money supply, and this is the determined interest rate. This is the determined interest rate. Now, central bank purchased the foreign exchange. Then what happened? The domestic currency will go up. So the domestic currency will go up means our money supply curve shifts to here. It shifts to here. So when the domestic currency goes up, the money supply curve shifts to here. It will ultimately result to lower the interest rate. Now the interest rate is going down, but because when the central bank intervened into the foreign exchange, this result was not anticipated. This is an unwanted side effect of the foreign exchange intervention. Now, because of this higher money, low interest rate, there can be an inflationary threat. So, to avoid the adverse impact from this unwanted side effect, central bank want to absorb back this unwanted side effect through the sterilization process. For that, what they have to do, they have to keep that money supply back to the previous level. Now they want to make this money supply back to the previous level. So what are the options they have to? They have to do this decision. So for that they use this market securities, basically government bonds or the securities issued by the central bank to players in the money market. So now here in this scenario, there is an unwanted downward pressure in the interest rate. So now the central bank wants to make the interest rate back to the previous level and to keep the situation back to the initial level. For that, they want to keep that money supply absorbed back to the central bank. For that, what they do, now they want to reduce the money supply. They want to reduce the money supply. For that, they have to purchase or sell government bonds. What they are going to do, is it a purchase or a selling? It's a selling, right? If they sell the bonds, if they sell bonds, what happen? I am now selling you a bond. So I am selling you a bond, you are purchasing it from me. So the additional excess money that you have will, again, the successfully central bank will drain out from the economy through selling bonds. So this can happen the other way around as well. If you are starting with the foreign exchange selling, if the foreign exchange selling happen, then the interest rate will go up. Upward pressure on the interest rate that is not wanted in the economy. So to take the economy back to the normal state, back to the initial stage, that means to increase the money supply back to the initial level, central bank will purchase bonds. So that is simply meaning of this sterilized foreign exchange market intervention. So that is the meaning of the sterilized foreign exchange market intervention, always to keep the unwanted effects back to the normal condition. They use the sterilization of the foreign exchange market intervention. But again, this sterilization process is also costly for the central bank, because central bank has to purchase or sell the bonds that will yield extra cost to the central bank. Now, under the operational level, we are coming to the third way that the central bank interfere at the operation level to influence the exchange rate, which is the regulation of the capital flows. Regulation of the capital flows. So there, what you have to know is the central bank, another possible way that the central bank can influence the movement of the exchange rate is the regulation of the capital flows. So here the international investors, the decisions of the international investors to invest or not investing in a country can affect the country's exchange rate, right? So that's what we discuss under the uncovered interest parity. So the decision whether to invest or not invest in a country by the international investors, that might affect the country's exchange rate, right? So let's suppose that if a international investors that perceive if they invest in a country would yield a good total return, then they would likely to pour capital into that country. For an example, if they perceive that our interest rate is higher than the international interest rate, then they will perceive that they can earn more by pouring their investment or the foreign exchange or the capital into our economy. So they will make this capital inflow to the economy, right? So it might affect the exchange rate directly, these capital inflows. Similarly, this foreign capital starts to flow in, then the country's exchange rate is likely to appreciate. Higher the capital inflows, that means our domestic currency is now stronger. So the exchange rate is appreciating, right? So the international investors would have to convert their foreign currencies into the domestic currencies, because now they are going to invest their money in Sri Lankan economy or in local economy. For that, they have to convert their foreign currency into domestic currency. For that, they are demanding our domestic currency, Sri Lankan rupee. So when they demand more and more Sri Lankan rupee, then what will happen? Our currency will become stronger. That means our country will appreciate it, right? So these inflows of foreign capital are often welcome in a country with an open economy. If you have an open economy, these inflows and outflows are openly welcome, right? So this inflows we can use to finance the domestic investment projects. But if many investors decide to pour capital into our country at the same time, then what will happen? This influx of capital could put a lot of upward pressure on the exchange rate, right? It's better that as a developing country, or if we have more investment opportunities in the domestic context, it's better to have capital inflows. But what happens if there's a sudden huge capital inflow into the economy? Then there is a unanticipated upward pressure on the exchange rate, right? So this might be especially a problem with a small emerging market country which does not have much capacity to accommodate the large inflows of capital. It's okay to have moderate level of capital inflows, but if there is a large influx of capital in a short period of time, especially for the small emerging economy, they might they might face difficulties to handle this large influx of money to the country, right? If that happens, our country's exports are likely to become less competitive, because if there's a large influx of inflows, our country's exchange rate is appreciated. When the exchange rate is appreciated, the exports are become more expensive. So our exports become less competitive in the international market, right? So other than to that, there can be many distortion like international prices, wages. All these cannot be quickly changed in response to this quick influx of money. So this quick influx of money, we say these are hot money. That means unanticipated sudden inflow of money to the economy. We say that these are hot money. A large portion of capital inflows, we say it is hot money. So this hot money aims to capture quick returns. Normally these hot monies are not long lasting inflows. They are expecting to capture quick returns, right? So maybe through speculation in the stock and real estate market. Likewise, uh, this hot money was a fast appreciation in the exchange rate. So that results an economic distortions in the economy, right? So this hot money could lead to unproductive investment in the economy, and also it might create asset price bubbles in the economy, right? So these great adverse effects can be happen in the economy because of this hot money scenario, right? So because of that, there should be a central bank should be able to impose regulation to temper the magnitude and the velocity of such flows, right? Now you know what is hot money. Hot money is unpredictable large sum of capital inflows into the economy that the country may be not able to control or to employ this large influx into the investment opportunities. If that happens, this large influx might uh, cause a huge appreciation, sharp appreciation, sudden appreciation of the foreign exchange. It might result our exports less competitive in the international market, and also since we cannot manage this large inflow of money, which is hot money, this hot money should be regulated by the central bank, right? And the Tobin tax is a tax charged on the spot foreign exchange transaction. Because of the Tobin tax, there is a extra cost on the currency conversion, and thereby it will lower the potential total returns from cross-border investment. Tobin tax will prevent the hot money or the large influx of money uh, in the intention of the quick returns. So because people know when there is a Tobin tax, when they are converting their currency into domestic currency, they have to pay this tax. So it might lower their return. So uh, it will demotivate the people to use this hot money for the investment opportunities. So lastly, unremunerated reserve requirements. That means a certain percentage of the capital that investors bring into the economy be deducted and held in special accounts that pay no interest for a specified period. So this unremunerated reserve requirements means a certain percentage of the capital that investors bring into the economy be deducted and held in special accounts that pay no interest for a specified period. Again, it will create the investors demotivated to use hot money into the economy. So these are the ways that the central bank can regulate the capital flows into the economy. So today we discuss how the central bank influence the exchange rate at the macro level and the operational level, and we discuss some of the definition of the equilibrium exchange rate. So overall, what you have to know, there are certain theories in the exchange rate determination, there are certain definition in the exchange rate determination. So over these theories, definitions not may be fully applicable into the practical scenario, but what we have to know is all this together gives you the foundation what the central bank can do in terms of determining the exchange rate. So that's all for the today's session. Thank you very much.